Momentum. Wouldn't it be nice to know if the trend could be stalling or even reversing? Measuring momentum, the rate at which price is changing, can give a trader insight into when the trend might end. Fortunately, there are plenty of momentum indicators to assist us with this task. RSI. The most common momentum indicator used by traders is the Relative Strength Index, or RSI. This indicator compares the strength of moves on up bars versus down bars. The measure of the speed and strength of price action results in the trader's ability to determine if a market is overbought or oversold. Overbought refers to a future that is trading well above its recent average price, where buyers have pushed the price up to an unsustainable level. Oversold is the opposite of overbought. Oversold refers to a future that is trading well below its recent average price, where sellers have pushed the price down to a level attractive to buyers. The RSI is a bounded study ranging from 0 to 100, with thresholds of 30 and 70 used as the traditional oversold and overbought levels. When the RSI falls below 30, the underlying is said to be oversold, above 70, overbought. Note that a market can remain overbought or oversold for an extended period. When price moves below 70 or above 30, the trend could be changing and can be interpreted as a signal to buy or sell. Because RSI has the same scale regardless of the traded instrument's price, you can compare RSI values across multiple markets to get a sense of which markets are overbought, oversold, or neither. Incorporating momentum indicators in your trading regimen is a smart way to understand the strength and direction of the current trend of a market.